Matter of fact, 5.25%. That was Realty Income's annualized dividend yield using its August 10th closing price and the dividend declared for August of 2026. Put $1,000 into the shares, and the current payout rate represents about $52.50 a year, paid monthly, real cash. Now, automate that $1,000 purchase every month for 10 years, and you contribute $120,000. A historical reconstruction leaves you with roughly $140,000 after federal taxes and liquidation. The same transfers into Vanguard's total market index fund leave roughly $234,000 spendable after federal taxes and liquidation. A gap of about $95,000. Brief pause. The 5% number was accurate. It also failed to answer the question you thought it answered. You are standing between two blank brokerage accounts. One buys Realty Income, ticker symbol O. The other buys VTI, a low-cost fund covering nearly the entire investable United States stock market. Both accounts receive $1,000 on the first trading day of every month. Both reinvest whatever cash survives federal tax. After 10 years, both are sold. The ledger tracks income, taxes during ownership, basis changes, fund expenses, market value, and the tax due when you liquidate. No state tax, no trading commission, same dollars, same dates. Before putting anything into that ledger though, the thumbnail deserves a fair hearing. Realty Income declared its 673rd consecutive common stock monthly dividend in July of 2026. The August payment is 27.1 cents per share, or $3.25.2 annualized. The company has increased its dividend for more than 31 consecutive years. So the monthly dividend is not decorative marketing language. The payment history is unusually persistent, and the company owns more than 15,000 properties across the United States and Europe, generally leasing them under long contracts. You are not buying a fake income stream. You are buying a real operating business with contractual rent coming in and a long record of sending part of that cash to shareholders. That matters, because the fastest way to ruin this comparison would be to invent a weakness Realty Income does not have. The relevant documents are not one magical prospectus containing your personal answer. You need Realty Income's annual report and Securities and Exchange Commission filings, its dividend declarations, the company's annual tax allocation documents, and the prospectuses for any fund used in the comparison. That document stack creates one ledger with separate lines for the distribution, share price performance, expenses, federal tax, adjusted basis, and sale proceeds. And the first correction goes in Realty Income's favor. If you buy Realty Income shares directly, there is no fund level expense ratio, 0. You own stock in the company. You do not automatically lose 1% or 2% a year to a portfolio manager before receiving the quoted yield. A broker may have account costs, although commission-free stock trading is common. Realty Income's own direct purchase program says the company pays the plan's investment fees. Either way, an expense ratio does not belong on the direct stock line. Fees enter only when you choose a wrapper. VTI charges 0.03% annually. Vanguard's broad real estate ETF, VNQ, charges roughly 0.13%. An actively managed real estate fund can charge several times that amount, sometimes approaching or exceeding 1%. Those are different products. You cannot charge VNQ's fee to Realty Income, add an active fund's fee on top, and call the result an audit. That is not analysis. That is a pile of unrelated receipts. Direct Realty Income therefore keeps the expense box at 0. VTI gets its 0.03% cost, which is already reflected in the fund's reported returns. By the way, if you appreciate document first housing and portfolio math, subscribing helps Lazy Investor reach more people. I'm grateful to everyone who does it. Removing the false fee does not rescue the thumbnail, because the larger correction appears when the score changes from income paid to wealth created. On August 10th, 2026, Realty Income closed at $61.89. Divide its annualized $3.25.2 distribution by that price, and you get about 5.25%. That figure is current yield. It answers a narrow question. If the dividend rate and share price stayed where they are, how much annualized cash would the shares distribute relative to today's purchase price? It does not say the investment will grow at 5.25%. It does not include a future change in the share price. It does not promise dividend growth. It does not account for tax. And it says nothing about what earlier buyers earned. Realty Income's trailing 10-year annualized total return was recently reported between roughly 3.3 and 4.3%, depending on the precise ending date and reinvestment method. The National Association of Real Estate Investment Trusts reported about 4.3% in late July of 2026. Another daily series ending around the same period produced closer to 3.3%. That range is not a reason to pick whichever endpoint supports your opinion. It is a warning that dates matter when a stock begins the period near a high valuation and finishes after a major interest rate cycle. The current yield is above 5%. The measured 10-year total return was around 4%. Both can be true. Imagine $100 of Realty Income stock pays $5 during the year. Your brokerage account receives $5, which feels productive and visible. But if the shares finish the year worth $97, your economic result before tax is roughly $2, not $5. The distribution enters through one door, while market value leaves through another. Total return counts both doors. Over the decade ending in 2026, Realty Income's dividend did much of the work, while its share price contributed little. And on some exact date comparisons, the price-only result was negative. The monthly payment remained dependable. The capital did not compound at the payout rate. Reliability and competitive wealth creation are different qualities. A paycheck can be reliable while your net worth remains flat. A bond can pay every coupon and still lose market value when rates rise. A REIT can increase its dividend while investors reduce the price they are willing to pay for each dollar of that income. Realty Income was especially exposed to that repricing because rising interest rates changed the alternatives available to income investors. When Treasury securities and cash began offering meaningful yields, a 5% REIT distribution no longer looked as rare as it had when safe rates were near zero. The business kept collecting rent. The market changed the price of that rent stream. VTI experienced the same 10 years very differently. Vanguard reported a 10-year annualized return, a little above 15% through May of 2026. A first trading day monthly contribution reconstruction ending August 10th puts $1,000 per month at roughly $272,000 before personal tax. That result already includes VTI's expense ratio. It also includes reinvested dividends. The total market account did produce income. Its yield was lower, but the earnings retained and reinvested inside thousands of companies contributed to share price growth. This was never a clean contest between an income-producing asset and an asset that produces no income. It was a contest between two different ways of delivering total return. And once you see that, the investigation changes. The question is no longer whether Realty Income's dividend is real. It is. The question is whether that genuine income created competitive, spendable wealth after the tax system touched it. Most of Realty Income's ordinary REIT dividends do not receive the lower qualified dividend rate. They are generally taxed at your ordinary income rate. But the common claim that every dollar is automatically taxed at 37% is incomplete. Eligible REIT dividends can receive the Section 1990A deduction. That deduction was made permanent under the federal tax legislation enacted in 2025. It generally allows an eligible investor to deduct 20% of the qualifying REIT dividend. For an investor in the top 37% bracket, taxing 80% of the eligible distribution produces a regular federal rate of 29.6%. If the 3.8% net investment income tax also applies, the combined effective federal rate on that eligible REIT ordinary dividend is about 33.4%. A qualified dividend taxed at the maximum 20% capital gain rate with the same net investment income tax faces about 23.8%. So take the current 5.25% yield as a separate cash illustration. If the entire payment were an eligible REIT ordinary dividend and you were subject to those top rates, your after federal tax current cash yield would be around 3.5%. Your $52.50 becomes roughly $35. Carefully. That is an illustration of current cash yield. It is not your after-tax total return. The share price change still has not entered the number. Realty Income's tax documents add another correction. its distributions are not classified identically every year. In 2023, about 7% of the annual distribution was classified as a non-dividend distribution, commonly called return of capital. In 2024, it was around 30%. In 2025, it was roughly 34%. Return of capital is generally not taxed when you receive it. That sounds like a tax-free dividend, but the accounting receipt does not disappear. It reduces your cost basis. If you bought shares for $1,000 and later received $100 classified as return of capital, your adjusted basis may fall to $900. Sell the shares for $1,000, and you now have a $100 gain that did not exist under the original basis. Tax was deferred. It was not necessarily erased. The unusual year in this decade was 2021, when Realty Income completed the Orion Office spinoff, and a large part of the reported distribution was classified as non-dividend. That event makes a fake penny-perfect internet backtest especially unreliable, because the result depends on whether the data provider handled the spun-off shares and basis allocation correctly. There can also be capital gain distributions, including amounts reported as unrecaptured, Section 1250 gain. Your annual tax form identifies those categories. That is different from saying you personally depreciated Realty Income's buildings and must automatically pay landlord-style depreciation recapture when you sell O shares. You did not claim depreciation on those properties. The REIT did. Selling publicly traded REIT stock is ordinarily a stock sale calculation using your adjusted share basis. Return of capital can enlarge your gain, and certain distributed gains can receive special treatment, but there is no automatic conversion of your entire share sale into direct property depreciation recapture. Now, the ledger can be completed without charging imaginary fees or imaginary taxes. The historical reconstruction begins with $1,000 invested on the first trading day of each month from September of 2016 through August of 2026. Dividends are reinvested after the applicable federal tax. The high earner case assumes the net investment income tax applies, uses the Section 1990A treatment once available, excludes state tax, and liquidates both accounts on August 10th. This is a rounded reconstruction rather than an audited tax return. The available adjusted return series handle the 2021 spinoff differently, and 2026 tax classification will not be final until after year-end. Pretending those uncertainties are worth 12 digits would make the calculation look better and the analysis worse. The pre-tax Realty Income reconstructions cluster around $150,000 after $120,000 of contributions. That is consistent with a money-weighted return of roughly 4% over this contribution schedule. Across the period, the account receives approximately $32,000 of gross distributions. The number is larger than the $30,000 pre-tax gain because some of that income was offset by weak share price performance. Roughly $8,600 goes to federal tax during ownership in the high earner illustration. About $23,400 remains available for reinvestment. Return of capital classifications reduce basis by approximately $6,400. Your contributions, plus after-tax reinvestments, minus those basis reductions, leave an adjusted basis around $137,000. Because taxes removed cash before it could buy additional shares, the account reaches only about $140,000 before liquidation, rather than the roughly $150,000 shown by a full pre-tax dividend reinvestment series. The remaining taxable gain is small. After the final federal sale tax, you have approximately $139,000 of spendable wealth. You contributed $120,000. 10 years of a famous monthly dividend added about $19,000 to what you can spend under this tax illustration. That is not a loss. It is also nowhere near the result suggested when current yield is mentally promoted into an expected growth rate. VTI begins with the same $120,000 of transfers. Its historical monthly reconstruction reaches approximately $272,000 before personal tax. The fund distributes much less cash along the way, roughly $14,500 in this reconstruction. Most of that dividend income receives qualified treatment, although the exact qualified percentage changes by year. Taxes during ownership consume around $3,400. The reduction in reinvestment trims the presale account to roughly $266,000. Its basis, including the after-tax distributions that purchased more shares, reaches about $131,000. Liquidating the portfolio creates a much larger taxable gain, so the final federal bill is close to $32,000. And after paying it, your spendable VTI balance is approximately $234,000. Realty Income leaves about $139,000. VTI leaves about $234,000. The gap is roughly $95,000. Lower voice taxes contributed to that gap, but taxes did not create most of it. Fees certainly did not create it. Direct Realty Income had no fund expense ratio, and VTI's cost was 0.03%. The dominant line was performance. Standard financial conversations often put an income asset's yield beside a growth asset's total return, as if the two percentages answer the same question. They do not. One measures cash distributed relative to today's price. The other measures the combined change in your economic ownership. That comparison can make 5% of visible cash feel superior to a lower yielding portfolio that quietly compounds earnings through price growth. Your brokerage statement does not care which part was emotionally satisfying. At liquidation, every root has to become the same unit, money you can spend. If these source-driven comparisons are useful, a subscription helps me keep making them. Thank you to the people who have already subscribed. The base case changes when your objective changes. Put Realty Income in a tax-advantaged account, and the annual tax drag disappears. The account can retain and reinvest the full distribution. That moves you back toward roughly $150,000 before any tax owed on future retirement account withdrawals. VTI moves back toward roughly $272,000 under the same no current tax treatment. The tax shelter improves both accounts. It does not rewrite the historical performance record. A lower taxable income bracket also narrows the tax disadvantage. At a 22% ordinary rate, the Section 1990A deduction can reduce the effective regular rate on an eligible REIT dividend to 17.6%, and the net investment income tax may not apply. The difference from qualified dividend taxation becomes modest. The wealth ranking over this particular decade still does not reverse, because the pre-tax performance gap was far larger than the tax rate gap. Put the REIT exposure inside an active fund, charging around 1%, and the answer deteriorates. Over 10 years of monthly contributions, one additional percentage point of annual cost can remove several $1,000s from a portfolio whose underlying return is already modest. That does not make every active REIT fund irrational. A manager may provide diversification, sector selection, or risk controls you value. It means the wrapper must earn its place rather than borrowing Realty Income's zero-expense direct stock economics. A retiree spending the distribution instead of reinvesting it has a different objective again. Realty Income's monthly cadence may fit a cash flow plan. The payment can reduce the number of manual sales, and its long dividend history may make budgeting psychologically easier. VTI's lower yield means you may need to sell shares to create the same spending cash. Selling shares is not financial failure. It is one method of turning total return into income. But some investors value the discipline and emotional comfort of receiving a scheduled payment. That comfort is real. It is not additional return. You are also accepting concentration in one company, one capital allocation team, and a business model sensitive to property values, tenant health, acquisition spreads, and interest rates. VTI gives you exposure to thousands of businesses, but with more dependence on broad equity valuations and a different pattern of volatility. Neither asset performs every job. Realty Income can serve an income allocation. A diversified REIT fund can provide paper real estate exposure. A broad market index can serve long-term wealth accumulation. The correct comparison begins by naming the job, then measuring every candidate in the same unit. Paper real estate has its own version. The dividend can be an income decision or part of a total return decision. Pretending the yield proves both is where the ledger breaks, slows down. The 5% was not necessarily false. It was the answer to the wrong question. A yield belongs beside total return, tax treatment, wrapper cost, adjusted basis, and ending liquidity. It can never stand in for them. To the wrong question. A yield belongs beside total return, tax treatment, wrapper cost, adjusted basis, and ending liquidity. It can never stand in for them.